I think we can get started. Good morning and welcome to today's Tuesday Market Outlook webinar. My name is Prakash Vijayanath. I'm a senior analyst here at Options Play, and today I'm going to be walking you through my thoughts and analysis on the current market. So before we get started, just a quick disclaimer. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or solicitation or an offer to buy or sell any securities. This video was not intended to be used for individual tax, legal, or investment planning advice. Our agenda for today will be starting off with the major equity indices, highlighting some of those key levels. From there, we'll be moving on to fixed income and commodities. We'll take a look at the sector rotational model, highlighting which sectors are outperforming and underperforming the overall market. Take a look at a couple of subsectors of interest that I have for you today, and we'll end today's webinar with some bullish and bearish market observations. So starting off here with the S&P 500, and we can see here that overall the thesis remains bullish. We have spoken about this for the last few weeks, especially with this breakout above 445 minor resistance. This is when price was consolidating ahead of earnings season, and earnings season overall got to a good start with the major banks posting or having earnings announcements that they were okay, they were good, generally positive. And since then, we have seen price continue to rally. There was some minor resistance in this level, just around 455 really. But price is managing to continue to rally higher despite that. So it is running into some resistance, but it is continuing to grind higher. We are seeing rotation, or slight rotation out of technology. And given the fact that technology has such a huge weighting on the S&P and the NASDAQ, it is going to be a bit of it's going to be a bit of a headwind for the major indices to continue higher. However, on the bright side, we are seeing improved market participation in this rally, with all the other sectors starting to improve relative to technology as well. So S&P 500 doing quite well. I do expect this to continue to rally, with the next key level being basically at all-time high territory between 470 and 480. We do know that markets are pricing in a more dovish Fed. We do know that markets are pricing in interest rates being cut sooner rather than later, despite the fact that we did get an interest rate hike last week that had already been priced in, well before that meeting. So right now, equities are in a good space. In terms of inflation, labor inflation is coming down better than expected. And we still have strong consumer spending, which, despite higher interest rates, which is always good news. So we are seeing, not that many headwinds here for equities. I mean, it does depend as well, because we have Apple and Amazon earnings this week. So unless there's any major red flags from those earnings announcements, I could see the S&P reaching that all-time high territory very, very soon. Moving on to the NASDAQ 100, looking at the QQQ ETF, and we are seeing a very steady climb as well. A little bit of underperformance, but like I said, that's relative to the S&P, but like I said, that is because of the fact that technology is underperforming over the last few days, and the NASDAQ 100 is primarily comprised of technology stocks. Even though technology is underperforming, we are still seeing price above its 21-day exponential moving average. So it does indicate that this bullish trend remains strong. We are seeing price break out of this minor resistance level between 380, around 380 and around 380, 384, 385, and does look like price will be continuing higher. That being said, on the weekly time frame, it is a little bit overbought. So I wouldn't be surprised to see maybe some more neutral price action, especially if we continue to see that relative weakness in technology. But again, with technology, it's been providing leadership for so long, it's only natural for us to see rotation out of it and back into the other sectors, at least for a short time. So it doesn't necessarily invalidate this bullish thesis that we have for the NASDAQ 100. Maybe a bit more neutral and not as bullish as what it has been over the last couple of months. So in terms of upside targets, 400 and to 410, those would be the two key levels that I would be looking at to the upside. And overall, things are looking quite bullish here still for the NASDAQ 100, but it is important to note that it is, over the last few days, still underperforming the S&P 500. Taking a look at IWM, which is the Russell 2000 ETF. So we're looking at small caps here. And small caps are performing quite well, especially in the last few days, despite the massive red candle that we saw, just on Thursday. Price has actually managed to recover and has moved higher to this 200 level, which is a major resistance level. We can see it's a strong psychological level as well. And price has run into resistance near this area a couple of times before. That being said, it's still not the key level that I'm looking at. I'm looking at 210. I do think that a breakout of 188 does, show some encouraging move, or some encouraging moves here for 210. The 188 level is a 38.2 fib level, and the 210 level is the 23.6 fib level. And generally speaking, over the last couple of years, really, the Russell 2000 has been respecting those key fib levels. So we may see some pullbacks or some consolidation near this area of resistance, like we did see a few days ago, but we can see there's still a lot of underlying momentum. And especially in the last few days where the S&P and the NASDAQ haven't really moved that much higher, the fact that the Russell 2000 is quite encouraging for this ETF, and does, bring up the question of, is small caps back, back on the cards? Is small cap outperformance back on the cards? It's way too early to actually have a correct answer for that. But the last few days of price action have been quite encouraging, despite Thursday's very bearish day after a higher open. Okay, taking a look at TLT, the Treasury Bond ETF, and once again, we are seeing price find support at around the 9,900 level, and but still showing a lack of momentum. And we've seen that lack of momentum really in the last few weeks, where price was bouncing and respecting the support level, but unable to really break above even 104 in this case, and even more recently, unable to break above 103. So over the last couple of days, we saw another bounce higher. Price was looking like it was turning into a reversal and a continuation higher. However, this morning we're seeing a big gap down at the open. So let's see if price actually can still stay above this level today. Risk to reward, it's very tricky because it hasn't broken down support, but broken below support, and this has been a major area of support. But at the same time, it has been respecting this level of support, even though there isn't that much upside momentum. So my overall thesis is still bearish, but we have to respect this $9,900 level of support because it has been a major area. And despite the very bearish momentum on the last few occasions when it's hit this level, it's always managed to recover. So not something I'd want to trade yet, need a lot more confirmation either to the upside or the downside. Moving on to the US dollar. So the US dollar is continuing to recover after, starting off July on a very bad note, declining quite rapidly towards that below 100, finding some support at around 99.50. And then so far recovering, breaking above its 21 and 55-day exponential moving averages today, and breaking above also this 102 level. So there's a couple of key levels that we had to look at. We have this 101 area. I'm not sure why it's doing that. 1 second. There we go. So we had the 101 key level. That price, could have acted as some resistance before continuation lower, but it actually managed to break above that, came back to retest it, and has actually broken above the next key level at 102. So this is quite encouraging for US dollar recovery, and does open the door now back to a revisit of 103.50. Again, another key level to be looking at to the upside. So the US dollar is still going to be on the back foot from a macro perspective. Obviously, we have a dovish Fed, and with lower interest rates, the dollar does tend to weaken. But also, when you compare it to the other currencies out there, like the major basket of currencies that it's usually compared to, like the pound, the euro, the yen, these central banks aren't really in a position where they are going to be cutting down interest rates by as much as the Fed will be. Fed futures are pricing in 125 point hike. 125 point decline by this time next year. So that is quite significant. And none of the other central banks are doing that. So, looking from a pure interest rate point of view, the dollar is going to be on the bare foot, but we are still seeing, in the very short term, a bit of a recovery after a very strong decline from early July. Moving on to gold. So gold moves inversely with the US dollar. We saw price react to 184 once again, and this was the area that we've been looking at now for the last couple of weeks. And with dollar strength, gold is always going to be a bit weaker. And also when you consider the fact that it is a safe haven, the fact that we're in more of a risk-on rally right now, that might change somewhat, given the fact that we are seeing some consolidation or a slowdown in momentum in the major indices. But things are still quite positive for a risk-on rally. And therefore, I don't see gold breaking above 184 yet. I mean, I may be wrong here, but just looking at it from a pure fundamental perspective, I still think that 184 should act as resistance, and that'll be the bearish thesis for gold. And a continuation lower could be on the cards back down to 177, especially when the US dollar is continuing to find strength. Right, moving on to oil, looking at light crude oil futures. Price has reached our upside level that we've spoken about for the last few weeks. Ever since price broke above 74, we've been targeting this 82, 83 level of major resistance, especially when price broke out, came back to retest and bounced higher from that level. So now that price is at that level and momentum is a little bit on the overbought side on the daily time frame, I do think it's going to be time for either consolidation or a reversal lower. Again, this major resistance area could be the technical catalyst to see price actually decline quite rapidly. And when it comes to oil, on the bullish side, we are seeing supply cuts continuing to provide short-term strength, hence the very strong rally in such a short space of time. But also we have, recession fears, especially in China, that there might be some short-term reprieve from it with additional stimulus there, but at the same time, it's not a long-term solution. So that will always be a longer-term headwind for oil, is going to be recessionary fears. And the fact that it's at its major resistance level, the big question is, will it actually respect it or would it continue to move on higher? I'd like to see some more bearish price action at that level before making a call on that. But this is where, you really want to be looking closely at what oil does at these current levels. So moving on to sector rotation, and we've seen significant rotation here in the last week or so. 6 sectors now in the improving and leading categories and 5 in the lagging and weakening categories. So the big mover is actually technology, rotating very strongly from the leading category into the weakening category. And this is okay because considering the fact that it's been in the leading category for quite some time, it's only natural to see rotation out of that sector. And it is joining communications in this sector, which is continuing to weaken here relative to the broader market. Discretionary in the leading category is showing some weakness in momentum, but not a bearish sign just yet, in my opinion. It's still, the overall sector is still fairly positive. This could be some very limited rotation out of the sector. In the improving category, this is where we see the biggest shift. We have energy, financials, materials, real estate, and industrials. The big performers here are financials and industrials. So financials, they have their earnings season out of the way, and there aren't really that many huge downside catalysts that could see financials move back into the lagging category. So we could see this rotate closer towards the leading category over the next few weeks, and especially industrials as well, finding some momentum there. We have materials recently rotating from the lagging category and real estate as well. It's not the strongest sector in the improving category, but after a significant period in the lagging category, we are seeing real estate now find some momentum. Our 3 defensive sectors in staples, utilities, and healthcare, utilities, and staples, finding some momentum, but definitely not where you want to be invested in the short term, given the fact that we are still in a very risk-on sentiment. And there's better opportunities out there, like with these sectors in the improving category, or even for that matter, discretionary. Maybe not so much technology just yet. We'll see what happens with Apple earnings. That could be a huge upside catalyst for the sector. But for now, when it comes to the defensive sectors, still, even though we are seeing an improvement in relative performance, we're seeing an improvement in relative performance broadly due to the fact that the heavy weighted sectors are experiencing some outward rotation. So this is quite normal to see. And the fact that it's still underperforming the sectors in the improving category means that I don't believe that these 3 defensive sectors are where you want to be putting your money in for now. All right, moving on to some subsectors of interest, and we have XRT first off. So XRT is a retail ETF, and we've had a bullish idea here for XRT ever since it was breaking above that 64 area here. And since then, it has continued to move higher. It actually broke out, came back to retest nicely, and has continued higher. Some consolidation in the last week or so, but also showing signs of a breakout from those levels and continuation of this rally. So in terms of the next key levels that I'll be looking at, yes, 76 is really the upside target due to the fact that we saw double rejection there. However, 72 as well could be a level that comes into play, given the fact that it was a previous area of support. And it was also a previous swing level here, as you can see on the daily time frame. So that would be another level to be looking at. I'd view that as more of a minor level compared to that 74 to 76 level. Overall, our thesis remains intact, and yeah, so far XRT going quite well for us. Moving on to TAN, the solar ETF. So I do have a bullish thesis here for TAN, and I would say it's limited bullish, because it's running into support at 68 and it is respecting this level. There's no doubt about that, and has respected this level for quite some time. However, the larger trend is a little bit bearish. So usually, you want to respect the larger trend, but when it's, squeezing price at a 68 support, it does provide a very good risk to reward bullish entry point, and maybe a very limited bullish entry point with a play on this trend line. So I don't expect price to necessarily break above this trend line, but if you utilize something like a credit spread from these current levels, one, you could stop loss it when price closes below 67. So you're losing a very limited amount on that credit spread, but your take profits would be at around that 72, 73 area. So there's significant upside potential compared to the downside, hence why I say it is a good risk to reward bullish entry point. We are seeing momentum also not reach an oversold level, but approaching the 200 area is already starting to recover from that. And normally this is a range where we tend to see a reversal from a momentum perspective here on the 50-period CCI. So it does look like, from a technical perspective at least, that the solar ETF TAN could be in store for a short-term move higher. Moving on to GM, so General Motors. This was a bearish idea that we've had now for a couple of weeks, when price is at around that around 40 really, when it was rejecting that 40 level of major resistance. Did provide a good risk to reward bearish entry point, and so far price has declined back down to 37. So it is a trade that's doing quite well for us. However, it is stalling a little bit at this level. So this is where you may want to take some partial profits and let the rest of the trade run, and move your stocks to break even. The one thing I will say though is momentum is also declining quite rapidly. So that is a positive for this bearish trade. However, it is at this area of support at around 37. So those are the two things you want to consider. And because there's some ambiguity now, best take partial profits, and eliminate the leftover risk, and also let the rest of the trade run in case we do get a home run and General Motors continues to decline, especially if it breaks below that 55-day EMA, the blue line. That would indicate much further continuation lower. 36 minus support could be another downside target, but ultimately you have a 33 level, which is a major support level. Okay, taking a look at AMD. So AMD, bullish thesis on AMD with price reacting to 110 support. So once again, it is respecting the support level. There's no doubt about that. However, we are seeing a clear lack of upside momentum. So again, another good credit spread opportunity. A put credit spread will work out very well in this case, as long as price, depending on your strikes obviously, but as long as price stays above that 110 level. Even if the price moves neutral, you have time decay working in your favor, and that should yield a positive trade in a few days. So when it comes to AMD, still respecting our bullish thesis, even though there's a lack of upside, there's still a nice opportunity here, as long as price stays above 110. Okay, taking a look at PayPal, which was a bullish idea that we've had, really since price broke above that 69 area, and it broke above it with some very good momentum. We saw price break above 72 as well. That could have acted as a resistance, but instead, it didn't really. It actually broke above it and used that level as support. And yesterday it moved a good bit higher, gapped up higher, with price actually rejecting that 76.50 level. So I don't think there's too much room to the upside in the short term. I think this is a good time to take profits, especially with earnings coming up. So another way of doing it is actually taking out partial profits, stops to break even, and let earnings do its thing. If there's a big move to the upside, that's great. If there's a big move to the downside, you should only have limited losses unless there's a significant gap down. But if you're a bit more risk averse, like me, it might make more sense to just close out the entirety of this trade. But PayPal did quite well for us in the last couple of weeks. Moving on to BMY. So BMY was another very good bearish trade that I would say is at take profit territory, or was actually at take profit territory a couple of days ago. So we're looking at when price was last week at this 55-day exponential moving average. I saw the rejection there, and that provided an excellent risk reward bearish entry point. And keep in mind, BMY was a trade, the bearish trade that we've been looking at ever since price is rejecting that 66 level. However, last week I was looking at another entry point for a move back down towards 60. And on Thursday, it did pretty much touch that price almost to the cent, and has since recovered. So in my opinion, this is BMY done and dusted over the last couple of months, really, that it's been a solid bearish pick. But the fact that it is now at a major support level, at that $60 level, which was a downside target really for the last couple of months, that does indicate that this trade is over for me. And we'll see, there might be some opportunities in the future once again, but this is a very good bearish play over the last few months. A new idea for today, and that is Zoom video communications. So Zoom has actually reached the 74 level, and it's rallied there quite impressively, finding some momentum at around 64, came back to pull back towards its 55-day EMA, and managed to rally up to that level once again. But take a look at the last three candles, three big rejections of 74, and price set to open a little bit lower this morning. So that is an excellent risk to reward bearish entry point for that continuation lower. In terms of my opinion on the magnitude of a move lower, I would still play a credit spread here. I would still go for bearish to neutral as opposed to debit spread, which relies on a large move in your favor, because there is still an underlying bullish rally. Price did form a new higher low at that 55-day EMA, but it is rejecting 74. So we could just see price, still below that 74 level, but continue to maybe squeeze that area. Or we could actually see a breakdown, but I would probably lean more due to the fact that it is still, the last couple of days have been quite bullish. I would still lean more towards a credit spread. So that's moderately bearish to somewhat more neutral. And if price breaks above 74 and closes above 74, that's when you'd want to cut losses on that trade. But either way, excellent risk reward downside play here. Okay, taking a look at JP Morgan. So JP Morgan, in terms of the big banks, is the best in class from a relative performance perspective, compared to the likes of Goldman, of Citi, of Morgan Stanley. JP Morgan's performance has been very, very impressive. So it's clearly the best in class. It's clearly where, if you are looking at a big bank, this is a name to be looking at. However, this isn't really an actionable idea just yet. The reason I wanted to share this thought with you today is because, we're seeing this obvious breakout above that 145 level with a lot of momentum. Now, price on the weekly time frame is approaching, or is pretty much at the overbought territory with the 50-period CCI near 200. And we can see some rejections there on the daily time frame. So what I'm going to be waiting for is a pullback lower, roughly to around a 21-day exponential moving average. Usually I like to see a pullback to a previous area of resistance turning into support, but that level's all the way at 145. I don't think we'll get that much of a pullback here for JP Morgan. So the next thing I'll be looking at would be dynamic support, which is the 21-day exponential moving average. And once we get a pullback to that level, we could see some bullish price action there, or after this retracement lower, and that will provide a good entry point for continuation of this trend with an ultimate upside target at around 170. So not actionable just yet, but a bit of patience required. Definitely want to add to the watch list and keep an eye on those pullbacks. So with that, that is all I have for you today. Thank you so much for joining me, and I hope you all have a great trading week. I will see you next week for another Tuesday Markets Outlook webinar. Goodbye, everyone.